Absolutely. So, one, thanks for everyone who's attending. I appreciate the opportunity to speak to all of you. So I just wanted to spend a few minutes, talking about our firm and our fund. I launched the fund in 2011, and the thesis behind launching our strategy was really after living through two 50% corrections, the tech bubble and the housing bubble. We thought to ourselves, there has to be a better way to invest in equities, right? There has to be a better way to avoid these steep losses and these corrections. And so really the goal was to create a strategy that can weather any market, any environment. And so when we start on this venture, we looked at timing the market. We looked at, how can we forecast the market? How can we look at the market and the indicators and use our knowledge in market cycles to create a strategy that can provide returns no matter what, right? And so I'm going to share my screen real quickly just to show you one or two charts. So this is a chart of the S&P 500 over the last 20 years. And if you look at it, believe it or not, on a weekly basis, the S&P has been down almost 45% of the times, right? So that's a lot of downside alpha to capture, right? That's a lot of alpha that's being, given away if you're just buying and holding the market. If you're a passive investor, if you're not trying to time or position yourself around the market, either through timing or asset allocation or through different strategies. The next slide, which is one that I'm sure everyone has seen, is how does a portfolio perform if you can avoid those down weeks, right? And you can see that blue line. It's astronomical, right? It's exponential growth. Now, obviously, this is exaggerated because this is using hindsight and picking out the worst weeks, but it just gives you an idea of the amount of alpha that can be captured and the returns that can be generated if you are able to avoid even some of those down weeks. So, our strategy, it's a systematic market timing strategy. We've spent the last 7 years incubating the strategy. We just opened it up to outside investors. And that's why Marty's saying, we're not emerging in the typical sense in terms of time. We are in terms of size because we just opened the fund up to outside investors. And so, a lot of times people ask us, well, how do you time the market, right? So that's, conventional wisdom tells you you can't. Everyone says it's impossible, and we achieve the impossible, right? And I acknowledge that on a day-to-day basis, you probably can't time the markets, but definitely on a weekly, monthly, and a short to intermediate term basis, you can absolutely time the markets. And that takes a lot of expertise, right? It takes a lot of research, a lot of experience, and a lot of academics to know what indicators, what moves the market, and how to time the market. So the way that we look at timing the market, our view of the world, is we break it into three different buckets, right? One, we use indicators that are contrarian and have momentum. We look at indicators that provide turning points, and then indicators that provide a trend. We also look at data like as market data and behavioral data, because a lot of the market is behavioral, and a lot of the data can be predicted by behavior, right? When you see the curve start to flatten, it's common behavior for investors to get nervous and to allocate towards safe haven assets because they're worried about a recession. Same thing as you see with inflation. As inflation starts to rise, it's common behavior for investors to anticipate a rise in interest rates, right? So these are repeatable behaviors and patterns that can be built into and can be modeled. The third thing is, we look at our data and we use different frequencies of data. We use different speeds of algorithms, and that's what allows us to be nimble and to have that short to intermediate term view on the market. And so the way our strategy works is we have a factor model that takes into account a wide array and wide number of indicators from different disciplines. We look at volatility data, interest rates, commodity prices, sentiment, earnings revisions, so indicators from many, many different disciplines. And we meld that together into an algorithm that then predicts, whether to be risk on or risk off on a weekly basis, right? So this is not a day-to-day strategy. This is a week-to-week strategy. And so the benefits of this strategy are, one, the way we execute it is when we're risk on, we invest in the S&P 500, a broad index. When we are risk off, we invest in long-term US Treasuries. And so the benefit of our strategy is it provides diversification two ways. It diversifies against unsystematic risk, which is, that single stock risk by buying the index, and it diversifies against systematic risk because we are timing the markets. We are timing those macro events, and trying to avoid them. Our strategy is uncorrelated with almost any other asset class, right, which makes it very unique. I have rarely ever heard of another strategy that's similar to ours that tries to time the market. And the model is systematic, right? It removes any emotional or discretionary bias. The way we execute the strategy, we use E-mini futures. We use E-mini S&P and E-mini long-term treasury bond futures. They provide tax efficiency. They are 1256 contracts, which provide a 60% long-term capital gains rate and a 40% short-term. So despite the short-term nature of the strategy, investors get that tax efficiency and that tax benefit. So the strategy, it's a weekly. The strategy on average rebalances about 16 times a year. So it on average, it holds a position for 3 to 4 weeks. That could be as short as 1 week. It could be, longer. It could be for months. That really depends on the data. And it really depends on the indicators that are being put into the strategy. And then the risk management that underlies the entire strategy is also systematic. So we've built an algo-driven risk management strategy that's there to stop us out, preserve capital for investors, whether we're in equities or we're in bonds. And that's very important because the number one priority of the strategy is to preserve capital. And number two is to generate alpha in any environment. So you can't do one without the other. And so our fund, we've averaged about 30% returns over the past 3 years. We target 30% returns net after fees and expenses. We target a 2-sharp ratio. And so, our goal is to provide that, over the long term. Now that's not, every year. Last year we were up 147%. Some years, we're up 10, 20%. So some years we're up 80%. It depends, right? It's not every year, but on average, the target is to be 30% annualized returns. And so, our team, I'll put up this chart just to show you our team. Our team consists of myself, consists of our chief operating officer, our director, and we have a software developer. So we're a small team of 4 people that are running this strategy. And really, that's about it. We have all the third parties in place. NAV is our admin, Cohen Resnick is our auditor, Oracle is our compliance firm. So we have all the typical third-party service providers, the high-end providers, to support the strategy and the fund. So I'll give a couple of questions. So the size, the ultimate, I guess the limit of the fund is $1 billion, right? We're using a very liquid strategy, very liquid instruments. We're trading, E-mini futures. So there's a lot of liquidity. Currently, the fund is 15 million, which is why we consider ourselves emerging. We just started raising capital last year, and we've been raising money almost every month since. The goal is to get to 50 to 100 million by the end of this year. And then the ultimate goal, is to raise a couple hundred million, but the capacity is probably about $1 billion, given the nature of the instruments that we trade. The minimum investment is 250,000. The terms are very easy. It's a 1% management fee. It's a 20% incentive fee. We have a high watermark. There's no lockup period, no redemption fee. It's monthly subscriptions, monthly redemptions, right? So it's very easy terms because the instruments are so liquid. And to be honest, our thought and the reason why we spent so many years, spent 7 years incubating this strategy, right? We didn't just do a back test and go out to market to try to, raise money and collect fees. That's not the goal. The goal is to generate returns for investors, right? So we took our time purposefully making sure that we had a strategy that could achieve that goal over the long run. And it took a while, but we got there. And so for us, if the fund performs, we're happy to accept, a small amount of money, and we are confident that investors will add to the fund. And if the fund doesn't perform, frankly, then investors should not be in the fund and they should redeem, right? Our goal is not to hold anyone capture just to collect fees. Our goal is to generate, substantial returns for investors. Question is, who do you compete with? So I would say we compete with absolute return funds and systematic funds. I don't know any other fund that tries to time the market, to be honest. There are other firms that provide sort of a hedged approach using VIX or options and puts and stuff. But I don't know of any other fund that does what we do and takes our approach. So I would say, our competition are other absolute return funds and systematic strategies, but still they're quite different. So I think that's all the questions that I see. Once again, I appreciate the opportunity to talk about the fund. If you have any questions or you'd like to talk individually, I'll put my contact information in the chat. Please feel free to reach out. I look forward to talking to everyone.